Let's play a little game of imagination. Envision checking your brokerage account to see that an extra $100,000 suddenly appeared. Seriously, picture your jaw dropping to the floor in disbelief. Now, what would you do with the money? Book a lavish trip you've always dreamed of? Make a down payment on a house? Maybe squirrel it away for a rainy day? I'm betting most didn't think, let me carefully research undervalued stocks to buy. But that's exactly what the legendary Warren Buffett would do. See, while we fixate on spending windfalls, Buffett thinks in multiples. He asks, how can I invest this to keep compounding returns over months, years, and even decades ahead? And it's this long-term, wealth-building mindset that's catapulted him to over $100 billion as the world's greatest investor. Intrigued by how an ordinary guy from Nebraska reached such stratospheric success? Well, turns out Buffett relies on just 3 simple golden rules for stock picking, principles designed not for Wall Street, but for Main Street. Welcome to MoneyWise Investor, your trusted source for financial insights. In today's video, we will distill Buffett's decades of wit and wisdom into 3 simple golden rules for investing success. But before we dive in, do us a solid by hitting that subscribe button and notification bell. That way, you'll never miss any of our game-changing investing insights and strategies to boost your net worth. Now, to unlock the power behind Buffett's golden rules, we first need to understand what makes his philosophy so unique and what sets him apart as an investor. So, why does Buffett's investing rules matter? In the frenzied world of finance, short-term thinking runs rampant. The latest hot stock captivates investor attention one minute, only to come crashing down the next. But Buffett plays by different rules. Rather than chasing temporary trends, he focuses on the long game. Buffett prides himself on selecting companies poised not just to prosper next quarter, but to drive steady value over decades. Now, if you're to pick and hold only one stock over the next 30 years, what company would you trust to drive steady returns, year in and year out, even as technology changes and new competitors arise? Not an easy question for most. But Buffett would answer in a heartbeat. Coca-Cola, no doubt. After first buying shares in the late 1980s, Buffett has proudly held his Coke stake for close to 35 years now, patiently letting those dividends roll in. You see, while other investors obsess over chasing short-term trends, Buffett plays the long game. He tunes out fleeting market noise and asks, does this company have an unsaleable competitive edge that can compound value not just over years or even decades, but potentially generations? Essentially, does this business have staying power beyond our wildest imaginations? If yes, he's happy to buy, even during market dips, and just patiently waits as earnings pour in. The result? Over half a century of absolutely decimating market returns, cementing his status as the greatest investor alive. It's this ruthless focus on long-term winners that truly sets Buffett apart. See, most look at investing through a narrow lens. Will stock X beat earnings next quarter? Is now a good time to buy stock Y? But Buffett zooms way out and spots what others dismiss in their frenzy. Companies with the ultimate lasting power, thanks to a near monopoly-like hold on their markets. Coca-Cola falls into this rare breed. With unmatched brand equity and distribution scale fueling insane customer loyalty, Buffett knew Coke dominated beverages today and likely forever. And with over 50 years of market-crushing returns in the books, seems like he was onto something. So, if you're ready to start achieving Buffett-esque returns yourself, strap yourself in as we outline his 3 golden rules for stock picking for beginner investors, designed specifically to uncover companies just like Coca-Cola, companies poised to grow, and compound wealth not just for years ahead, but generations. Rule number 1. Invest in simple-to-understand businesses. Yes, the number 1 golden rule to achieve Buffett-level returns is that you must stick to simple businesses you understand inside out. Now, this advice goes against our human nature. When flashy, complicated companies make headlines, it's tempting to dive right in. But fight the urge. No matter how exciting the story, you'll likely eventually lose your shirt investing in businesses you simply don't comprehend. But wait, you might be thinking, does understanding mean I need some fancy finance degree before I can invest? Absolutely not. You just need a reasonably accurate picture of how the company makes money, so you can estimate future earnings potential. Imagine you came across a hot new company, generating buzz for its breakthrough cancer treatment. Exciting stuff. But here's the catch. You have zero clue how to evaluate medical trials. The science flies miles over your head. Would you still bet your hard-earned savings on this stock? Hopefully not. Or say you come across Acme Software Company. They use sophisticated algorithms to create enterprise management solutions, leveraging cloud infrastructure, machine learning, and big data analytics. Sounds impressive, but unless you have experience in the tech sector, good luck deciphering their 271-page annual report to figure out their profit drivers. Instead, you'll likely be guessing blindly about future prospects. Now, compare that to McDonald's. They make money selling affordable fast food worldwide. Pretty straightforward, right? No complex tech or trial evaluations, just simple burgers and fries. Given your likely familiarity with their menu and locations, you can reasonably gauge performance drivers like food costs, finance royalties, pricing power, and more to determine earnings potential ahead. No fancy finance degree is required. As Buffett warns, putting money into businesses you simply don't grasp is no better than gambling in a casino. No matter how impressive the headlines are, there's no way to judge future profit potential without understanding the operations. Essentially, you want to stay within your circle of competence. Focus on easy-to-comprehend businesses, where you can make informed forecasts about future profitability, rather than playing guessing games. This one simple rule filters out the overly complex, technical companies that often seduce investors. Now, just because an operation is straightforward doesn't automatically make it a winner. For that, Buffett emphasizes zooming out the lens to gauge a company's lasting power, which brings us nicely to our next rule. Rule number 2. Adapt a long-term mindset. In a market obsessed with split-second trades and next quarter's outlook, practicing the lost art of patience has become a superpower. You see, Buffett thinks generations ahead. He invests today in companies he believes his great-grandkids will still be profiting from. Talk about perspective. Adopting this mindset means turning out all the short-term noise bombarding us daily. Earnings misses, scandals, market swings, and so on. Instead, you laser focus on the underlying foundation. What gives this company its endurance and resilience through thick and thin? The key is spotting special companies wielding what Buffett calls an economic moat, a structural competitive advantage, protecting juicy profits long into the future. Think Tesla's Silicon Valley flair and Apple's cult-like brand loyalty. Over short periods, prices may fluctuate, but over enough years and decades, profits from these moat-protected giants compound faster than we can imagine. But how do you identify an economic moat that can stand the test of time? Well, rather than technical financial metrics, Buffett applies a common sense lens. For example, ask yourself, can a new player easily replicate this company's offering? If it's a simple product like mattresses, probably yes. But for a complex integrated platform like Amazon Fulfillment and web services, fat chance. Next, gauge customer loyalty. Look for names behind beloved brands, like Disney. When people adore the product, they'll keep coming back and forgive missteps, preserving the money machine. Finally, analyze industry dynamics. Ask yourself, is the company benefiting from secular shifts, meaning growth could persist for decades? Like healthcare giants, as aging populations demand more care. Run companies through this timeless framework, and you'll uncover the gems positioned to compound greater wealth than we can fathom today. The last step? Ensuring you don't overpay. Which brings us to Buffett's final golden rule, and it's the key to supercharging any portfolio's performance. Rule number 3. Buy wonderful companies at fair prices. Alright, we've covered where to fish for outstanding stocks poised for greatness. But knowing when to reel them in for a bargain separates the novice from the Buffett. Pay too much, and even deserving stocks can sink returns. That's why Buffett's final golden rule is all about patience. Wait for quality names to reach attractive prices before taking the bait. But how low is low enough? Great question. To guide his buy decisions, Buffett turns to intrinsic value. What price tag would fairly reflect all future owner earnings from this exceptional enterprise? It takes research, but ballparking this figure gives you a reference point to gauge if current prices offer a discount. For example, during times of widespread fear, like recessions, prices can sink far below reasonable figures. Say Coca-Cola is fairly valued at around $60 today, given its predictable cash generation. But news of a virus outbreak tomorrow spreads hysteria, sending it plunging below $30. In reality, the financial engine driving Coke remains as sound as ever. So for Buffett, this screams buy opportunity, thanks to the market's overreaction. But severed from emotions, Buffett stays clinical in his analysis. Is there still ample margin of safety between the price paid and intrinsic value received? If yes, he floods the market with buy orders, while others scramble for exits. Fast forward a few years to calmer waters, and Coke returns to $60 where it belongs. Meanwhile, Buffett pockets a casual 100% gain thanks to seizing the panicked mispricing. Rinse and repeat this for decades, and you'll understand how patience compounds wealth. So next time there's blood on the streets, fight the urge to panic like the herd. Emotional decisions lead to short-term thinking. Instead, zoom out and get analytical. Is this quality company simply on sale or facing existential issues? If the former, congratulations. You just landed a prized value investment primed to mint money over the long run. Rinse and repeat the Buffett way, and transforming your portfolio into a wealth compounding juggernaut may prove easier than imagined. Now, before you head off to crush the markets, armed with this new wisdom, kindly do us a favor. If you enjoyed our time together and found value in these lessons, we'd greatly appreciate it if you could tap that like button. And if you'd like to join us on more wealth-building adventures, make sure to click subscribe and turn on the notification bell. Now go out there and level up your portfolio, Buffett style. Until next time, stay MoneyWise.